Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, August 20th, and we'll see how things look for Thursday, August 21st. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. All right. Now, the damage wasn't all that bad by the time we finished the day, but we were down about 1% when we hit the lows. Right after the open, the market went into free fall, but eventually the buy the dippers came in and were able to push prices back up, and we actually recovered a lot of what was lost, and that's positive in and of itself. Some of our charts are still showing signs of improving, but at the same time, we're seeing what we've been looking for, going back to about the middle of July, of this historical weakness. And remember that we have yet to have a positive August in a post-election year when you calculate things all the way back to 1950. So is this what's starting to happen now? But it's encouraging, though, that once we finally found a base of support, that the market was able to come up out of that. Now, we're still positive. We did drop below the 20-period moving average, but we were able to get back above it and close above it. So that's still keeping the short-term positive. We're seeing a little bit of weakness developing in the intermediate term. The long term is still holding up quite well. So right at the open, we did have a lower open, and then we just kept going down after that. We saw pretty quick selling. We quickly dropped down below S1 at 63.89, so now we're under that 6,400 level, and we dropped below S2 at 63.66, but we found support at around the 63.50 level, which happens to be a pivot point for the NASDAQ. That's why I look at other indexes. Even though everything I do is focused on the S&P, we look at the Dow, we look at the NASDAQ 100, mid caps, small caps. There was a time back in, I believe it was 2023, when we were actually really focusing on the mid caps because they were the ones that were providing support. We would hit a pivot point in the mid caps, come up off of that, and the rest of the market would follow. So you never are really sure what the market's going to focus on as a point of support. It could be within the S&P 500 itself, but it could also come from other indexes. It can come from oil. It can come from interest rates. That's why we look at all these different areas to see how are they impacting the S&P. All right, but we rebounded back above S2 and only to stall at S1. So now the market turned a little bit more choppy, and we chopped between S1 and S2. We tried to get back above the 6,400 level, but ended up closing slightly below it. So that is fairly positive in and of itself, even though it was a down day, even though the daily chart is not showing you how the day transpired. That's why I use an intraday chart. That's where you get a feel for what's happening within the day itself. So we were just down 0.24% by the time we closed. We're still below average with volume, though, and we're still positive on all time frames. Interest rates didn't change all that much. And the scenario that's coming in, it's almost a week old now, and it came into the market when we had the PPI report that came out last week. CPI came out earlier last week, and that was okay. PPI came in showing some inflation concerns, and the market's kind of been riding that ever since then, worried about, okay, these inflation numbers are showing up at the producer level. Are they going to go over and show up in the consumer level? And that has more of an impact because that affects everybody right there. And there's still all the headlines and talks and pop news about what's going on between the talks with Russia and Ukraine and the U.S. being involved and all of that stuff. Of course, if you like Trump, you like what's going on. If you hate Trump, you're going to hate what's going on. It has nothing to do with what's really going on. It's just whether you are more or less a supporter or a non-supporter. Okay, so some comments. Mega caps and tech did underperform. Now we're seeing this again. This happened in Tuesday's session, and we've seen it a few times going back to the beginning of July. We saw a few days here and there, but then growth would come back in and take over, and that's when the market would go back up. Well, we're seeing the mega caps start to show at least more than one day now. This could change at any time, but they continue to underperform, but they did improve. And this is where some of the bounce up that we saw later in the day came from. And growth underperformed value. That's another thing. The market is turning more defensive. And then Intel was down 6.9% after a report. And this is not the same Intel that I remember because I got involved in the early to mid 90s, and Intel was the big name. They were a big name back in the dot-com boom. They were one of the more established companies. The markets just now, like everybody waits for Nvidia's earnings. Well, the markets used to wait for Intel's earnings to come out, and they've kind of drifted back, and they're not as powerful as they used to be. And so they're looking at different alternatives here. So they're having conversations with investors seeking to offer equity stakes for a discounted price. That's not a positive thing. It's like, okay, we'll give you some more stock here, but the stock might be selling at 20 or 30. Well, how about if we give it to you at 15 or 10 with the hope that it will go up in value at that point? And that's a more of a defensive measure. That's when it's like, okay, instead of looking at things really growing and maybe giving you a premium amount, hoping that the price will come up to that and then go beyond it, it's like, okay, we're a little bit more desperate here. Then the S&P does continue to be more defensive ahead of Powell's speech on Friday. Now that's what's being cited as why the market's doing what it's doing right now. And that can be very true. I mean, the market, they knew about the speech in June of 2022, but they were playing it as though that speech was going to be market friendly and the market was going to continue to go up. And then he came out and said some things the market didn't like. We hit some overhead resistance, turned and went down. And 2022 ended up being a very challenging year if you're positive on the market. Now, is that what's really happening? It could be. It's being cited as part of the cause for this. Other things that we need to look at is that we're hitting overhead resistance with the S&P. We've had a pretty good run up, a very good run up since the April lows. And it's probably about time to take some profits. And then there's seasonality that comes in, that it's the summer months, and typically in August and September, and oftentimes even into October, that tends to be weaker times in the market. It also can be some very strong times in the market as well. Then there was muted reaction when the FOMC meeting minutes came out, but it's not really changing the overall scenario that we've been dealing with. And these meeting minutes showed that there was broad support for keeping the Fed funds rate unchanged at 4.25 to 4.5, which is where they're at right now. They did not cut rates. Inflation and employment risks remain concerns. And now the Fed's switching over and they're a little bit more concerned about inflation. The employment situation, even though that report that came out on August 1st didn't show any strength, and then prior months were revised down, we're still positive with those numbers. And that was only one report. We'll see what comes out when the September report is released. But now we have PPI showing some of this inflation. Is that going to bleed over into other areas? And we're still holding with the 20-period moving averages. Now that's both the simple and the exponential moving average. And we did lose support though. In yesterday's video, I showed a chart of the QQQs, which is the ETF for the NASDAQ 100. We were right at the 20-day moving average in that area. We're now below it. Now, is this a leading type of indication of what's going to happen in the market? Because usually when we're going up, it's the NASDAQ 100 and even the NASDAQ itself that's leading the market higher, and then the S&P tends to trail behind. When we start to go down, it's usually the NASDAQ 100 and NASDAQ that go down more first, and the S&P does decline, but it tends to hold up better since it's a balance of growth and value. And we only have one thing. We're not seeing any positive short-term momentum now. The only thing that we could put on that list, because we're getting some extreme readings, would be the stochastics, but they're all negative. They're all declining. But some of them haven't declined enough to come out of their extreme positive reading territory yet. Nothing in the intermediate term. And I haven't changed the overall scenario. I kind of dealt with it up here in this other bullet point. For the most part, the Fed's been concerned about inflation. They've been concerned about employment. And so, rather than cut rates, they're just deciding to wait and see. And at some point, they'll have to make a decision. Now, there's still some time. We've got about a month until the next Fed meeting comes up. We now have the minutes from the previous meeting. So the market is a little more, at least they understand a little bit that the Fed's doing what they were doing before. But then there's the big speech on Friday that Jerome Powell is going to give. The dollar was down and interest rates were down. Now, you notice here we're at 4.3% where we were at 4.3%. After Tuesday's session, we had to round down to get to 4.3. In Wednesday's session, we rounded up to get to 4.3. So they were, maybe I said that in reverse, but there's a lot of decimal places that interest rates move and stock prices as well, but we usually only see the two decimal places after the whole number there. And sentiment is now drifting back more negative. Now, it's positive overall since we're coming in at 56, but the context is that we're declining because we had been at 60 and we dropped down to 56. And we are still trending. Now, it's getting a little dicey, and I'll show you the charts here. That green line's coming down and the red line's going up. But now the ADX is starting to weaken. We were above the moving average. Now we're starting to drop below the moving average, suggesting a weakening trend. And we're now below the moving average, as I said. And this is what, the fourth or fifth down day we've had? Now, some of the earlier down days were minuscule. Now we're seeing a little bit more of a percentage move to the downside, but at the same time, not more than 1%. So when you look at other big moves that we've seen, especially in 2025, these are rather muted. But because we've been chopping along and not showing a lot of conviction as we work our way through August, these moves look a lot more pronounced. And now with the momentum, I'm still keeping it positive, but then now I'm throwing it over into mixed, just because we're seeing some internal weakness that's starting to develop. Okay, so we only got the MBA Mortgage Applications Index. We get this every week. It was down 1.4%, where last week when we had this report, it was up 10.9%. You break that out on refinances, they were down 3.2%, where the purchase index was up 0.1%. And here is a chart of that showing how the overall reading did decline. Then some IsabelNet blog charts. We get this chart from time to time. It's put out by Real Investment Advice. It just shows the disconnect between the long-term growth trend and earnings. And it's been up in this red area now for quite some time. And when we get to really lofty levels, we've seen it. Here's the tech bubble, the real estate, and then we went into the great financial crisis. Then we had some problems there in the early 2010s where things kind of shifted around. And then here, this is when we came up out of the COVID crash and things were just getting really overextended. Well, we're overextended again. But I've shown this chart numerous times over the last month or two, and we're seeing pretty much the same reading. It hasn't really adjusted much. Then also, since the whole COVID lockdowns and things are changing and advances in technology, we're seeing more of a disconnect between the truck tonnage index, which is in yellow and going sideways, and the S&P itself, where for a long time, going back all the way here to 2002, we see the purple line and the gold line pretty close to each other. Now we're seeing more of a disconnect. And we see this periodically too, looking at the valuation. We've been overvalued for years now. We continue to be overvalued, with the S&P coming in at about 23. It's probably a little lower than that with the decline on Wednesday, since this chart was before the market opened. But there are the 11 sectors that make up the S&P and there's a few of them that are even more expensive than that, where you have industrials, discretionary, and tech. Now, industrials tend to go more with what's happening with the economy, and they've been pretty good. They've been a better performing area. But then we have discretionary and tech. Those are growth areas, and they're still considered to be quite expensive. But the market doesn't seem to care about that. And we still have staples, which have been going up, and that's a defensive area. That's at 22. And right at 20, we have communication and materials. And way down here at the bottom, these are the more defensive areas like healthcare and energy. They're coming in more fairly priced. And recent mutual fund and ETF flows, a lot of money still going into money markets. We're seeing more money going into bonds now, and it's trailing off a bit with money that's going into stocks. Forward consensus with the 12-month PE ratio here. You look at the aggregate index, that's in dark blue, coming in at about 23. That includes the mega cap stocks that really drive the index. But when you look at the equal weight version of the S&P, it's above that 15 level, but it's still below 20, coming in now at 17. And we're seeing a drop off here with newly private owned housing units authorized in permits. Okay, so this is dropping off. That's showing some weakness. Then discretionary positioning has been closely and inversely tied to rates. And we look at this down here where we see the MOVE index. This measures the volatility of bonds, and that's this purple line here, where actually this is going up and it's inverted, so that means bond volatility has been going down. And then discretionary, where folks are, again, they're trying to say, do I get into stocks? Do I get into bonds? Is this a good time to get in? Is it a better time to get out? And we're seeing a pretty strong correlation here between the two. But this only goes back to 2021. And then earnings sentiment. This is how are people feeling about earnings going forward. I show this pretty much once a week. The U.S. still is the most optimistic when it comes to earnings looking forward, and then the other countries that are included here. And then switching over to a different source, but these often end up in the Isabel Net blog charts. Retail activity. A lot of people are still buying. And I showed some other charts earlier that shows the professionals, they're not. They're doing some selling, but you've got the retail folks, that's you and I, that do things through a broker. They're still buying a lot of stocks. Buy the dip, buy the dip. That's one thing that is really touted out there. Something that I don't practice, but probably most people do. If you want to buy a stock at 10 and it falls down to 9, it's like, hey, I'm getting it on sale. My attitude is, well, if it falls to 9, what's going to stop it from falling to 8 or to 7 or to 6? Now you're seeing a loss. I tend to be more of a momentum type of person where I want to buy into strength and sell into weakness. All right, then inflation expectations by businesses is dropping off, but then leveled off in the latest reading. That's looking out 1 year. And then the estimates here, where it says on Friday, Powell may not guide the markets towards a September cut. Earnings per share expectations for small caps are already extremely bullish. It depends on which index you look at. You look at the Russell 2000, yeah, we're overextended. We're as high as we are with the S&P 500. You look at the S&P 600, and that's more fairly priced. So, okay, it depends on how you look at things and where you get your information from. And that's one reason why I use both indexes and focus on them, even though I don't personally deal with the small caps. With earnings expected to grow by more than 80% over the next 2 years, okay, good luck with that. They've been expecting this for quite a while now, and it just hasn't materialized with the small caps. Should interest rate relief be delayed, small caps will likely underperform. And they've already been underperforming. They have a couple of good days and then give those gains back. And here's some charts to try to bear out what they're saying in the headline. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. So, we did have a lower open, and then it's like we fell off a cliff here compared to what we've been seeing as far as price action lately. We came all the way down below S1, S2. We found some support here, and this was a pivot point on the NASDAQ. And then we finally settled down here and saw some buying coming in, but then we dropped back down to S2, which was still acting as support. But then we couldn't seem to really get above S1 until later in the day. We broke above S1, but then closed down here, and we're just slightly below the 6,400 level. So it was pretty crazy right off the bat. But that's one of the benefits when we see a real big decline right after the open. There's still time left, and there's a lot of people that are short-term traders and day traders. Eventually, they're going to want to come in and do some buying and see if they can, you know, if there's a lot of them doing that, then they come in and start to drive the prices back up. And then we're not really seeing much of a change in the initial overnight reaction here with the futures, but there was really not much to signal the decline that we saw on Wednesday before the market opened. And that's what we've been seeing lately. Any real big moves in the market is not coming from the gap from one day to the next. It's coming within the cash session itself. And this is turning more negative, but did see an improvement later in the day where we have the blue line below the red line. The red line's been holding up, that's value. And the blue line, which is growth, really, and we got hit hard with growth earlier on, but then finally we're able to recover a bit of those losses intraday. We're also seeing a bit of a recovery here, but when we started to get deeper into August, this is when we topped out with the S&P growth to value ratio. And with these moving averages, we're still going down. Now, we got back above some of these shorter term moving averages, but they're still trending down in the bigger picture, intraday anyway. So we were down more with growth than value, even though value was down slightly, down more with the mid caps with growth, and down less here with the small caps. A lot of the value got taken out in Wednesday's session there. So not much of a change here. We did decline, but we've been chopping along sideways with the small cap growth to value ratio. Mid caps did take more of a hit here. So we're seeing it dropping back down below its 50-day moving average. And we're also back below the 50-day moving average with S&P growth to value. So yeah, there's some weakness coming in. We still want to make sure we know the bigger picture. This is still in an uptrend though overall. But this is more weakness than what we've seen now in a while. And we did come a little deeper into the rainbow here with the growth to value ratio on this chart. And came down, but we're still positive in the bigger picture when we look at the equal weight discretionary to staples ratio. And we're seeing growth taking a hit here, where we look at the weighted version of discretionary to staples, that's coming down, but it hasn't really broken down below this gradual uptrend that we've been seeing. So a little bit of a hit here with the equal weight, which is the chart I just showed you. Where we're seeing a little bit more weakness is when we look at tech to utilities. That's been coming down after it had been chopping around. We also saw biotech, which is growth, to healthcare, which is value. That's underperforming now, and a bit of a turn down after we were seeing a bounce when we look at hotels to utilities. And going back up a little bit more into the rainbow when we look at the value to tech ratio here. That's an inverted version of the ratios that I had been showing previously here. And you can see now we're down below the moving average. The green line and the red line, they're not quite kissing yet, but they're close here. And so we're in a weakening trending environment. It's still barely positive with the green line above the red line. If we cross with the red line above the green line, that's going to turn the short-term trend, according to this chart, over to negative. Also below the moving average now with the intermediate term chart. And this is the chart that I focus on the most. I tend to do most of my strategies from an intermediate term perspective. And then I move it up a little bit for short-term strategies. And then I bump it out a little bit for longer term strategies. But this is showing some weakness, but it's still barely hanging on to being positive. We were below average with volume, which could be somewhat encouraging, but it was less below average. We've been seeing a gradual pickup in volume, but still below average overall. And we did tick up. We're still below 20 with the VIX, so that's not really a problem there. But the VIX is starting to go up. On a closing basis, we're still below the moving averages here with the line chart as well as the bar chart. And this is the seasonality that we've been wondering, is that going to happen? We got all the way up in the middle of August, and it really wasn't happening all that much. This big spike here, that was the one big down day that we saw after the employment report came out, and then the VIX was starting to settle down after that. Is it going to sustain these upward moves with the VIX, which means stocks are going down? And then we look at the VIX of the VIX, which is a volatility measure of the VIX itself. We actually ticked down a little bit here, but we're still above the moving average with the bar chart and the line chart. Still getting a high reading here with the skew index. These are out of the money options, so there's still folks that are anticipating a big move that apparently hasn't happened yet. And we were up just a little bit here with this fear gauge, but not much of a change. And we were up a little bit more here, a little bit of a tick up, though, really, with this other fear gauge. So we're seeing some fear coming back into the market. And the equity put call ratio daily chart did advance. And we're starting to turn back up with the 5-day chart, where we had been declining. And we're starting to turn up with the 10-day chart, which it had also been declining. When these decline, that's more positive. When they start to go up, that's more negative. And we look at a risk on to risk off ratio. I wasn't showing this because we've been chopping around a lot lately. Well, we're seeing this dropping off as the market is becoming more defensive. They're getting out of growth stocks, getting more into value stocks. And when that happens, we see this ratio coming down. But the bigger picture is that we're still going up. We're wondering, is this going to continue to go down and be more sustained? And high beta to low beta, they outperform when we're going up. Unfortunately, they go down faster when we're going down. Had been really choppy as we worked our way through July and into August. Now we saw a pretty big drop here with this ratio. And not seeing much of a change, though, with the volatility risk premium. We still had that very high reading right at the end of July. The employment report came out. We tanked. This has been declining ever since that time. And the advanced decline line, we actually went up a little bit based on price. And we did decline based on volume, but in the bigger picture, these are holding up and looking positive. Still above zero, we actually advanced a little bit with the short-term advanced decline ratio as well as the intermediate term. And we're still above zero and going up, not with a lot of conviction, but we're still remaining positive here with the 10-day advanced decline oscillator. And we did see some new highs coming in and really no new lows. So internally, we're not seeing a lot of deterioration. So the 5-day chart and the 10-day chart are going up. And we're still hanging on to being positive with accumulation distribution, which is interesting. We had a down day, but this actually bounced back up a little bit. However, you look at the boom indicator, the modified MACD, and that still continues to decline. So we're getting a mixed picture here. We want both of these above their moving averages and going up to see more confirmation in the short and intermediate term. But we're negative with our smart money indicator number 2. That continues to decline. And we did bounce up a little bit with the chicken oscillator, but we're not back above the moving average yet. So we're still treating this as negative, but improving. And we did see a drop off with the vortex. The green line's coming down, the red line's going up. Has a little ways to go before they cross when we compare them to the ADX or the trend condition charts that I showed a little while ago. And we just declined a little bit here with the NYSE common stock. We were flat with the S&P, declined but still above the moving average with the mid caps and small caps. And we're still above 50 and actually advanced a little bit with those stocks in the S&P above their 20-period moving average. We went up with the 50. We declined a little bit with the 100, and we were a little bit higher with the 200. But they're all positive because they're all still above 50. And this is what's looking like the overhead resistance on the daily side that we now are dealing with. We hit this pivot point, which is for August. We came up here, we got a little bit above it, but that's about when we started to stall out. And now this is looking a little bit more vulnerable as we've been declining, even though we closed up off of the lows. And we showed, again, a little bit of an improvement with the exponential moving average on 20, 50, and 200 when we do this right on the S&P itself. But we did decline, and we're dropping below the midpoint with the Stochk RSI. We're declining, but above the midpoint with the Williams percent R. But the context is that this is declining. Also declining and getting a little bit below the midpoint with the CCI 14 and a little bit above the midpoint with the CCI 20. And we're negative in the short-term stochastic. We're no longer extreme, but we're also declining in the intermediate short term. We're still extreme positive. That's why this is still on the list of extreme positive readings. But the context now is that we're dropping below the moving average and declining. So that's turning this chart negative. And we're falling a little bit below the midpoint with the force index. So that's switching over and looking more negative and seeing some more vulnerability with the short-term trend. We're below the double and triple exponential moving averages based on 20 periods. And now the lines are starting to roll over. And we did drop below the 20 period simple and exponential moving average, but we were able to get back above it and close above it. So on a closing basis, this support level has held for right now. And we did drop below the midpoint with our standard deviations chart, but we were able to get back above the midpoint by the time of the close. Now we switch over to the intermediate term. We're still showing some improvement here. This could be rather encouraging. We were seeing a negative divergence as the S&P was going up and the balance of power was going down. Now we've been under pressure the last few sessions here, and the balance of power is actually going up and crossing back above zero. We're still looking more negative, though, with the go, no-go, with the lighter blue bars. We did drop below the midpoint with the highest high, lowest low value, but we closed back above the midpoint. And now we're at day 77 with the length of this uptrend that started according to the Landry Light right at the beginning of May. Still positive with the proper order. And still looking more negative, though, with the TTM squeeze. We have the darker blue bars, and we're seeing this starting to come back down. Excuse me. And for the first time in a while, since August 1st, I guess you would say, we actually dropped a little bit below zero with the ease of movement. This is just flatlined. Once we got into June, even though we were going up, we haven't seen this indicator moving all that much, and it's usually pretty spastic, but it hasn't been lately. Still looking positive, even though we're flat with the Arun, showing that there's more buyers than sellers. And we tick down just a notch here with the S&P McClellan oscillator. You would expect this to drop below zero. It didn't. It did come down a little bit, but this is still looking a little more positive. So ever so slightly, even though we're waving along here, we're going up a little bit based on price, but we're declining based on volume. So this is back to giving us a mixed picture. We want them to confirm each other, either positive or negative. And we declined a little bit, but not all that much. And we're still below zero with the NYSE McClellan oscillator. So again, it's hard to see, but we're ticking down slightly with the summation index based on price and volume for the NYSE. And we're negative with the Swindler trading oscillator, declining based on price. We're just a little bit above the midpoint here based on volume. And we're turning more negative again with the momentum. We're down below the moving average and not above this red line, so we're not extreme with the PMO. But we did tick up just a little bit based on price, but we're declining based on volume. So this is where we're seeing price leading volume a little bit, because volume's coming out of the really big stocks, and that counts for more. And money's going into smaller stocks where we see some improvement based on price, but we're not seeing that same improvement based on volume. Tick down, but still above 50 with the PMOs that are rising. The buy signals are still going up, but they haven't quite come back to 50. And we are drifting back up slightly here after we had been declining with the PMOs that are above zero. But we're neutral, or excuse me, negative after being neutral with the Elders Impulse system for the S&P. We're still positive with the parabolic SAR. The dot is underneath. And we tested these moving averages here. We almost got down to this 30-period exponential moving average. We were able to close back above the 20-period exponential moving average, but now we're below the 10-period simple moving average. But still the lines are continuing to go up, even though they're slowing down. This is the intermediate term trend. We're starting to drop a little bit below this based on 50 periods. So the lines are starting to roll over when you look at the red line, but the blue line's continuing to go up. And I'm keeping an eye on this. If we had fallen further below the 20-period moving average, the next area of support would be this anchored weighted moving average here, but we didn't get down to that level. In the meantime, this chart is still positive. All these lines are still continuing to go up. And here again, we drop below the 20-period moving averages, but we close back above that. And we're kind of flat to sideways right now with the slope oscillator. That's a short-term oscillator. And we're dropping back down a little bit here with the MACD. It was right on top of the moving average. Now it's starting to drop below the moving average. So now some weakness is starting to come back in and with our two short-term oscillators, and we're seeing some rolling over here with the intermediate term. We're flat with the two long-term oscillators here, and they never did cross above their moving averages. And rolling over, but still hanging on to barely being positive with the Copic curve. Still above 50 with the money flow and above 50 with the ultimate oscillator. And we did decline, but we're still above the moving average with on-balance volume. Now it's going to turn things a little more negative if we end up dropping below this. And we're declining. So the context here with the Sean trend meter is that this is turning more negative, even though it's in the green area. And we are declining with the RSI intermediate term and short term, but we're still above 50. And we did finally see a decline. Now, after Tuesday, we went up with the bullish percent index. On Wednesday, we came down and we're dropping below the moving average. That's turning this more negative now. And we saw a decline here with the NYSE bullish percent index, and we're back below 50 with the NASDAQ 100 bullish percent index. And believe it or not, we're working off of a now praying bottom Fisher buy signal. Now, I wouldn't necessarily put too much into this. The better signals are when we get very low readings. And then we've been really screaming to the downside. It looks like we bottomed and now we start to go up. We're not seeing a very deep reading right now with this particular indicator. Now, this could still end up being a good signal. I wouldn't use this all by itself. There are times when we got some really good buy signals from this chart, but there's also times like back here in the early part of July. That was pretty good. But then we've been drifting off since then. But I would use other charts to confirm what we're seeing here. And we're coming down, dealing with the whole mini rainbow here. We got about to the lower end. We were able to close up just a little bit below the higher end of the 20-period simple moving average of the open, high, low, and close. And this is longer term. Now we're getting a little further away. This overhead resistance is at 64.68. We're now at 63.96 if you round this up. So this seems to have stalled things out, at least for right now, in the bigger picture. And we're coming up to the underside of this trend channel. We hit this, and this is when things started to really slow down. And we're more negative now with the Heiken Ashi chart. We're still positive since it's black, but we're continuing to point down with the Kegi chart. We're positive with the Renko chart and still positive with the three-line break. So getting some mixed trend signals here by measuring it different ways. Long term, we actually went up a little bit with the 150 and 200 period moving averages. So the long term is actually showing a bit of an improvement. And we're only negative now with the NASDAQ 100 in the short term. Now, if you over the weekend watched the intermarket analysis video, we've been seeing now going back to last spring where the NASDAQ composite has been outperforming the NASDAQ 100 on a ratio basis. So to see weakness in here first is not necessarily a surprise, but all the other indexes are still positive on all time frames. Commodities are still negative in the short and intermediate term. The dollar, since it got back above its probably 20-period moving average, that's looking a little more positive, where it's still negative in the intermediate and long term. And bonds are now looking more positive in the short term, where we were negative in the short and long term. So that's showing some improvement there. And you'll notice the areas that were up are defensive: energy, staples, healthcare. Now, we like that the financial sector is doing better, but then the growth areas, communication, tech, discretionary, those were the worst performing areas, with discretionary being down the most. A lot of red here. We had a staples BPI cross above 50. We just saw a BPI cross above 50 after Tuesday, then it crosses below, and then it probably kicked back and went positive later on. And then we had real estate had a bullish MACD crossover. That's a defensive area. Then we had the NASDAQ going down to 21.3210 blast off there. And then the Dow got above 45,000, but I believe it closed down below it. And then the S&P dropped below 6,400, and we're just right below it right now. And then we had a BPI cross with the tech sector back below 50. And then near the end of the day, we had a bullish MACD crossover with the energy sector, which is typically considered to be more defensive. A lot of red in the big boxes here. Apple was down, Microsoft, Nvidia, they were all down. Google was down, Meta was down, Amazon was down, Tesla was down. So not a good day for the mega caps. And the Dow still above this R1 pivot point. It was up 0.04%, where I think it was up 0.02% after Tuesday. So not really any gangbuster moves happening here. but it's holding up a little bit better above this pivot point. We're still in a longer term uptrend. And we've gone from positive to neutral with the diamonds with the Elder's Impulse system. This is the other daily chart NASDAQ where we came up here to this R1 level and then we started to go sideways and now we're coming down. We came down to this pivot point, and when we hit that pivot point was right about when we found some support in the S&P, and then we started to come up off of that and we closed up well off of the low, and that's seen as more positive. But we're negative with the NASDAQ with the Elder's Impulse system. We actually dropped a little bit below this pivot point, but we closed well up off of the low with the NASDAQ 100, but we're still negative with the Qs when looking at the Elder's Impulse system. The negative for the it's negative again here for the NASDAQ 100 momentum. And we closed right at the 20 period moving average for the Qs. Now we're below it. But again, this is encouraging if you're more positive on things. We open, we tank, and then we close up off of those lows. So yeah, it was a down day, but to close well up off of its lows is rather encouraging. And coming back down now to this longer term trend line on the weekly NASDAQ 100 chart. And we were down with the small caps. We have a couple of good days and then they drift lower here. But we could be getting ready for a golden cross with the S&P 600. As long as we stay above both of these moving averages, that will end up generating. And we are in an uptrend here with the Russell 2000 small caps, but they were down 0.35% and starting to trail off after having a couple of good up days. Still neutral with the Elder's Impulse system when looking at the small caps. Mid caps holding at this pivot point here. That was possible another support area, but mid caps haven't been playing as big of a role as what we were seeing a year or two ago. But they were down 0.4% and still above this pivot point. Going from positive to neutral with the Elder's Impulse system for the mid caps. We are dropping off but closing well off of the low with the Wilshire 5000. Financial sector was actually up 0.5%. We like that. That'll help this next chart, which is the ratio between the financial sector and the S&P. Now, there's a lot of damage that needs to be repaired here, but we are seeing a little bit of an improvement. Will we see more follow-through improvement? And we're going back up here with the staples to tech ratio. That means the market's getting more defensive. And the FANG index did come down to its 50-day moving average. It fell a little bit below that, but was able to close back above it. And so this is still hanging on to being more positive. So Apple was down almost 2%, and we had Amazon down 1.84%. Microsoft came all the way down to its 50-day moving average. Google was down over 1%. NVIDIA barely unchanged here, but still above its 50-day moving average. Tesla just gyrating all over the place. It was down 1.64%. Meta was down 0.5%, but it did bounce off of its 50-day moving average. And Netflix was virtually unchanged, but still below its its 50-day moving average. And I wanted to show this because we're still seeing an improvement. Even though we pulled back and we took a hit here, we're still above the rainbow when we look at the ratio between home construction and 3 to 7 year bonds. But this is an improvement after what we've been seeing so far into about halfway through 2025. And we're going back up again here with the staples to S&P ratio. And this is going up. Again, that suggests the market's getting more defensive. Seeing fairly strong short-term correlation between U.S. and world stocks. A little bit of a continuation up here with the longer-term correlation. And we were up with oil. We were getting into the lower 60s. Now we're working our way back up into the mid-60s. And the dollar is above its 50-day moving average, but still in a longer-term downtrend. And not much of a change here with the 10-year yield. So it's not coming into play, at least right now. And we were up here with the 10-year based on price. And we look at our growth to value ratios. Real drop off here with the Qs to S&P. After it had been holding up nicely, now we're seeing some weakness. We dropped, but we're still above the moving average with discretionary to the S&P, but now we're falling down below the moving average when we compare large cap growth to value. So we're below the moving average with the large caps, even further below the moving average with the mid caps, and still below the moving average with the small caps. All right, so we still have this big Jackson Hole, Wyoming symposium that's going to start on Thursday, and then Powell's going to give his speech on Friday, and the market's really anticipating that. That's being the fixation of the markets right now. That's what it is being touted as at this time. It could be that the smart money just says, okay, we're going to do more selling than buying. And if we do some buying, we're going to buy more defensive stocks. And we're still positive on all three time frames, but we are becoming more defensive. If we do start to go back up, we have overhead resistance on daily charts, weekly charts, and spread between the S&P, NASDAQ, and NASDAQ 100. So we're seeing a convergence of overhead resistance. And we'll get the initial jobless claims. That's been a big deal lately. The Philadelphia Fed Index. And this tends to not be that big of a mover. It's the global U.S. manufacturing and services PMIs. Those are two separate reports. We'll get existing home sales as well, and then the leading economic index. And then the geopolitical things. Any new developments between Russia, Ukraine, anything that blows up and makes the news between or it's happening now. It's kind of switched back to Israel and Gaza, dealing with Hamas there rather than Israel and Iran. But things are still happening there every day. And then we'll just have the speech by Chair Powell coming out on Friday. And that's kind of the big thing. Here is a look at what the previous readings were and if there's an estimate for the latest reading when those reports are released. Seasonally neutral to positive with the Dow, where we're neutral to negative with the S&P and NASDAQ for August 21st, going back to 2002. We are still working our way through the post-options expiration week, where we tend to be down more than up. And we now start to see a little bit more weakness during post-election years. The green dashed line, that is the S&P 500 seasonality for post-election years. And even if we look at the solid green line, which would be all years together, that's still seeing a few days more of weakness here before sometimes we get a little bounce going into the end of the month. Still have yet to be positive in a post-election year going back to 1950. This also shows negative seasonality. This also shows how the negative seasonality could last longer than just through August. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. And then we are looking at our more negative things here. We're seeing a mixed picture with accumulation distribution. The money flow is negative. Even though we ticked up a little bit, we're still below the moving average with the Chaikin oscillator. And the NYSE oscillator, the McClellan oscillator, and summation indexes, they're still below zero. Swollen trading oscillator is negative. And we have, this actually should be on the negative side. We did decline here. All three that I follow, the S&P, NASDAQ 100, and NYSE, bullish percent indexes are negative. The ease of movement, it's now dropping there. It's a slightly negative. And the momentum for the NASDAQ 100 is negative. And then the Zohorchak method. It's still at a -6, which is an improvement from a -10, but it's still a minus. Positive side, our growth to value ratios are getting hit, and we're seeing some damage done there, but they're still positive in the bigger picture. And the same thing with discretionary to staples. And then we're positive with the McClellan oscillator for the S&P, so that's sending the summation index based on price going up, but we're still declining based on volume. Parabolic SCR still positive. And I'm probably going to switch this over now because we're looking a little bit more negative with our momentum oscillators. The money flow and the ultimate oscillator are still above 50. The vortex weakening, but still positive. And the financial sector outperformed, but we need a lot more follow through to see this underperformance that we've been seeing going back to the beginning of May. And then the Pring bottom fish are a buy signal, which again, I kind of gave my warnings about that one. And then the long-term special K chart, which now I'll pretty much just show in the weekly videos because we only get maybe one signal a year from that chart. Here are the pivot points for Thursday's session. It's going to be pretty wide because we had a pretty wild day here on Wednesday. So our conclusion, we're still positive, and I measure that according to the moving averages. But we are becoming more defensive, and the market does have overhead resistance if we see an upward move. In the short term, there's no positive conviction. There's not really a negative conviction either. We're kind of right in between land, which is one of those newer areas of Disneyland, you know? All right, then intermediate term, we're still positive, but and we're seeing some weakness, but we're also seeing things holding up at the same time, and we continue to be positive here in the longer term. Thank you. I hope you found this helpful. Have a wonderful day, and I will talk to you in the next video.